Welcome back, traders. In this video, we are diving into one of the most important pieces of trading puzzle, your entry model. An entry model is more than just hitting buy or sell. It is a systematic checklist that confirms when the market is giving you a green light to enter a trade with confidence. So, what makes a good entry model? Number one, your market structure. Your entry model must always be in line with your market structure, your liquidity, and your POIs. First, market structure. This means you have identified a clear trend, like a break of structure or a fresh higher high. Next, your liquidity. There must be a low or above your entry point. Number three, your POIs. This is where you are looking to enter into the market from. You can't just enter into the market blindly buying or selling anyhow into the market. There must be a specific place you are looking, a specific area you are looking to get into the market. So these three must be in line. These three must mark out your checklist, your market structure, your liquidity, and your POIs. So how do we build an entry model? First, it must be in line with market structure. So what are we looking at for? In a buy scenario, we are looking for market to give us a shift in market structure, then a break of structure, then liquidity, then our POIs. What does that mean? It means we must have a sweep of liquidity, then a break of structure to the upside, now this has passed our first checklist. We have checked the box for structure. This signifies that market is bullish. Market is in an uptrend. Why? Because the market is giving us a series of higher high and higher low. So what is the next thing we look at for? We look at for is liquidity. In this case, this zone here, liquidity. Then what's the next thing? Then our POIs, which is the place we are the specific place we are looking to enter the market from. So what do? We wait for price to retrace back into this zone, then we look for buys and target this next high. Target this next high. Is that simple? So let's take a look at a real chart example of this playing out. In this case, let's use this set as an example. We can see price swept this high, broke structure to the downside. But firstly, you can clearly see that price was in an uptrend, creating a series of higher high. But what did price do? Price swept this high, and price was not supposed to break this low, but price broke through it anyways. And this signifies a shift in market structure. And price also broke this low here. And what did price do? Price pulled back into the zone, gave us our liquidity. Now, these have met two of our criteria, which means a shift in market structure, which signifies that market is now bearish, and our liquidity. What do we look at? We look at for our point of interest, in this case, our supply zone. So, notice price has already swept liquidity, broke structure, and there's an inducement liquidity here, which means this high is expected to hold. That means price is not expected to come back into this high. So what do? We place our sell limit here. Stop slightly above this high. Then we target the next low. A 1-to-3 ratio 5. This is how to build an entry model. So to recap all we have been saying, structure sets the direction, liquidity gives you a confirmation, a confidence that price is going to hold at your POI, then your POI gives you the trigger point that this is the perfect place to enter. So what validates your POI is must have swept liquidity, and there must be a liquidity above or below it, and it must be in line with structure, either a bullish or a bearish structure. So if you find this video helpful, smash the like button and subscribe. See you on the next one.